Ladies and gentlemen, good day and welcome to Q1 FY23 earnings conference call of Jubilant Ingrevia Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pavlin Singh Taneja, Director, Investor Relations, Jubilant Ingrevia Limited. Thank you, and over to you, sir.
Good evening, everyone. Thank you for being with us on our Q1 of financial year 2023 earnings conference call of Jubilant Ingrevia Limited. I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release and results presentation that has been shared on our website. On the call today, we have Mr. Shyam Bhartia, Chairman, Mr. Hari Bhartia, Co-Chairman, Mr. Rajesh Srivastava, CEO and Managing Director, Mr. Prakash Chandra Vish, CFO, Jubilant Ingrevia Limited, and Mr. Arvind Chukhani, Group CFO, Jubilant Bhartia Group. I now invite Mr. Shyam Bhartia to share his comments.
Thank you, Pavlin. We are glad to announce steady operational and financial performance in Q1 FY23 in the backdrop of inflationary headwinds leading to higher raw material and energy costs during the quarter. In our specialty chemical business, revenue grew 26% year-on-year on account of strong demand across all our product segments. We witnessed significant increase in input costs, including energy costs, which was passed on partially during the quarter, impacting segment's EBITDA margin. Our nutrition and health solution business, niacinamide sales volume, were significantly impacted due to spread of avian and swine flu in EU and US regions, leading to lower segment revenue and EBITDA. However, the price realization was better during the quarter. This is a short-term challenge in the segment, and business continues to maintain its market share and leadership position. In our chemical intermediates business, continue to witness strong demand resulting into volume growth. Business is maintaining the leadership position of acetic anhydride in the domestic market and also improving market share in Europe. On Y-on-Y basis, segment has witnessed normalization of market situation and lower acetic acid prices, which is also reflecting in both revenue and EBITDA. We are fully committed towards our growth aspirations, and we are excited to realize the emerging opportunities going forward in our business segments. We are fully confident of moving ahead with our well-defined growth CapEx plan, which is supported by our internal accruals. Our aim is to achieve sustainable, profitable growth in the medium term, and structurally we are poised towards moving on to the next tier of performance in our growth journey and margins. With this, I hand over to Rajesh to discuss the businesses in detail.
Thank you, Mr. Bhatia. A very good evening to all of you. At the outset, let me welcome you all for joining us today for Q1 FY23 quarterly investor call for Jubilant Ingrevia Limited. I sincerely hope that you and your loved ones are keeping very well. Let me now take you through the details of Q1 FY23 financial and operational performance of Jubilant Ingrevia Limited. Revenue during the quarter was 1,166 crores, driven by volume growth in specialty chemical and chemical intermediate segment. EBITDA during the quarter stood at rupees 151 crores. During the quarter, we have witnessed significant increase in raw material costs as well as energy costs. However, we have witnessed significant improvement in our logistics situation. We remain focused on continuous improvement in efficiencies using various business excellence tools and techniques to maintain competitiveness in ongoing challenging global environment. Sustainability is an integral part of our culture and purposeful action. We believe in delivering on our promise of caring, sharing, growing. In parallel to sustainability reporting, various ESG initiatives are being taken to enhance and drive long-term sustainable value for all our stakeholders, while minimizing the environmental footprint of our operations. Under CSR program during the quarter, our team completed the plantation of more than 1 lakh fruit trees in the community to ensure green coverage as well as sustainable livelihood to the farmer. Further, we have planned various other CSR programs designed in the area of health, education and livelihood of community around our facilities. Now let me take you through the update on all our three business segments. Specialty chemicals. Revenue of specialty chemical business was rupees 382 crore and EBITDA was rupees 64 crore during the quarter. Specialty chemicals revenue grew by 26% on year-on-year basis, mainly driven by higher volume across product segments. Revenue share to agrochemical customers grew significantly. We also witnessed healthy demand for oilfield chemicals. Segment EBITDA and margin was lower, mainly due to unprecedented and sharp increase in input costs, including energy costs, which was passed on partially during the quarter. Our newly commissioned diketene plant is now fully stabilized and we have achieved the design capacity. We are gearing up to meet the volume requirements of customers in coming quarters. We are witnessing positive traction in our chloropyridine range of products. Deliveries of our recently contracted CDMO products are happening on time. All our other products in CDMO business are moving as per plan. Our CDMO pipeline is healthy and progressing positively. Our new GMP and non-GMP facilities, which are expected to be ready during Q3 FY23, will help us in capturing growing demand of CDMO projects. For our other specialty chemicals products also, we continue to observe positive traction of demand from both domestic as well as international customers due to China Plus One strategy of most of our customers. Nutrition and health solution business. Revenue of nutrition business was rupees 150 crore and EBITDA was 19 crore. Our focus to maximize niacinamide share in niche segments like food and cosmetics is giving positive results. On year-on-year basis, the volume in food and cosmetics segment continues to see positive trends. However, overall niacinamide sales volume in animal feed segment during the quarter is impacted due to spread of avian and swine flu in EU and US regions, resulting into lower segment revenue and EBITDA, though price realization was better during the quarter. Flu situation in EU and US region is now improving and is expected to normalize during later part of the current quarter. This is a short-term challenge in the segment and business continues to maintain its market share and leadership position. In our animal nutrition and health solution business, our focus is to improve market share of existing products and to further increase revenue by adding new products and new customers for value-added specialty premix. Animal nutrition and health solution business is witnessing good traction for demand from domestic customers. Chemical intermediate business. Revenue from chemical intermediate segment is rupees 633 crore and EBITDA stood at rupees 76 crore. Our key product in the segment, acetic anhydride, witnessed strong demand resulting into 22% volume growth on year-on-year basis. On YOY basis, segment has also witnessed normalized market situation coupled with lower acetic acid prices, which is also reflecting into our revenue as well as EBITDA. After more than 1.5 years now, acetic acid prices seems to be stabilizing. Revenue from Europe and rest of the world has gone up significantly on YOY basis. Our market share in Europe has improved significantly and is continuing to grow. We continue to maintain domestic market leadership for acetic anhydride and remain the key supplier of ethyl acetate. We are witnessing good traction of demand for our new product, that is propionic anhydride. While we expect to continue our growth in market share in Europe market, we continue to maintain our domestic market leadership for acetic anhydride and remain the key supplier for ethyl acetate. Outlook and growth capex plans. We expect overall healthy revenue growth during FY23, led by volume growth in specialty chemical and chemical intermediate business segment. Commissioning of our 3 new CapEx, that is CDMO, GMP and 2 CDMO not GMP and acetic anhydride, is likely to aid the revenue growth. In the nutrition and health solution segment, niacinamide demand is expected to start normalizing during the later part of the current quarter. We expect our EBITDA of subsequent quarter of FY23 to improve, assuming no unexpected adverse situations. We are fully committed towards our growth aspiration, and we are excited to realize the emerging opportunities through our ongoing growth CapEx plan of rupees 2,050 crore during FY22 to FY25 period. We are strategizing towards improving our revenue mix of specialty and nutrition segment together to 65% by FY26 from 46% in FY22, and we believe this will be a key driver for our overall margin improvement. With this, I now hand over to Prakash to discuss the financials.
Thank you, Rajesh. A very good evening to everyone, and thank you for joining us on Q1 FY23 quarterly conference call. I would now highlight the company's financial performance during the quarter ended 30th June 2022. Revenue from operations during Q1 FY23 was at 1,160 crores as compared with 1,145 crores in Q1 last year, registering a growth of 2% on year-on-year basis. The EBITDA during the quarter was at 151 crore as against 287 crore in Q1 FY22. The margins stood at 12.9% in Q1 FY22 as against 25.1% in Q1 FY22. The drop in year-on-year EBITDA is mainly due to normalization of EBITDA in chemical intermediate segment, which was high in previous period due to favorable market situation. EBITDA margin of nutrition segment were impacted due to lower sales on account of bird and swine flu in Europe and USA region, while EBITDA margins of specialty segment were impacted due to high energy costs, which were passed on only partially during the quarter. Depreciation and amortization expenses during the quarter were at 31 crore. Finance cost during the quarter was significantly lower at 4 crores versus 13 crores in Q1 FY22, a reduction of 68% year-on-year on account of repayment of debt and lower interest rates. The tax expense for Q1 FY23 was at 36 crores. The company would continue to remain under the old tax regime during FY23, and the ETR is expected to remain in the range of 31 to 32% during FY23. PAT during the quarter was at 79 crore as against 168 crores in Q1 FY22, witnessing a decline of 53% year-on-year basis due to lower EBITDA. Gross debt as on 30th June was 285 crores and net debt stood at 228 crores as on 30th June 22. The blended interest rate for Q1 FY23 was 5.72% as against 7.09% in Q1 FY20. The net working capital percentage and number of days of working capital for Q1 FY23 on the basis of trailing 12 months turnover were at 17.9 and 65 days respectively. Increase in net working capital is driven by short-term decision to maintain higher inventory to manage uncertainty of market and supply chain situation. The capital expenditure during the quarter was approximately 77 crores. With this, I would like to conclude our opening remarks. We will now be happy to address any questions that you may have.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Hello, sir. Good evening. Couple of questions from my side. One, clearly the power and fuel implications seem to be quite acute for this quarter versus
Tarang,
this quarter.
somehow you're not clearly audible to us, please. Can you speak a little louder?
Please give me a second, please.
It's not clear.
No, you're not clear enough.
Hello? Hello?
Yeah, Tarang, you're not clear enough.
Hello? Hello, audible?
Yeah, now you are.
Okay. Yeah, just two questions from my side. Apologies. So one, the power and fuel expenses, clearly there was an acute implication in this quarter versus the base. Just wanted to get a sense exactly what happened and how recurrent is it going to be going forward. And number two, in the specialty chemicals business, was there a substantial contribution of the ketenes capacities, or will we see that those volumes come in, and how do you see the utilization of that commercialized capacity now going forward in FY23? Thank you.
So, Tarang, first question on this energy, which is coal. In our Gajarola plant, we use coal for power as well as steam generation, and we are allowed to have FSA coal, which is a contracted coal from the government. But because of the government decision not to supply coal to industries for short-term periods, we did not get those volumes which were at a good price. And we had to import the material, all the coal we had to import from outside, which were at a much higher price. So that has impacted hugely on our profitability for the quarter. This is in the tune of almost 45 crore. And even today, the FSA coal is not available, but we are expecting that from 1st of September, the coal will be now available to us from FSA. So that impact which has happened in quarter one, partly it will also have in quarter two. So that is one-time impact which we have never seen in the past. And your second question on specialty chemical, actually the diketene plant is very stabilized. We have achieved the capacity. Now we are gearing up to supply the volume to customers. So approval processes are on. Some volumes have started happening, but the actual real capacity utilization we will see from the Q2 end of Q3, quarter 3 onwards. We will actually see the real capacity utilization of diketene.
Okay. And sir, just a follow-up on the power and fuel and the fact that you were able to pass on some bit of it to your customers in specialty chemicals, but not fully. At least that's the sense that I got from the press release and the opening address. So going forward, how does that work? I mean, do you believe in your conversations with your customers, they're open to, because my sense is they would also be going through, significant inflation in their procurement.
No, so on all our products, all the input raw material costs we have passed on. This unprecedented increase of coal, unfortunately, was not fully passed on. So we are definitely capable to pass on the prices, but this was really unprecedented. So in future also, whatever raw material price goes up, we normally pass on. We have done that even this quarter. So that's why we are saying partially, because this unprecedented increase of coal was not fully passed on.
Got it. And so just last question on the chemical intermediates business. Given your, gaining market share in Europe and considering, the developments in Europe and the end, demand for your customer, are you anticipating some sort of softness in that business going forward, or do you believe that you'll be able to grow those volumes and gain market share in the manner in which you've been doing in the last 2-3 quarters?
Tarang, contrary to what you are saying, we are seeing the European market demand going up. The reason is that there are new uses of anhydride, as I have been explaining in my last quarters, that anhydride new uses have come which are consuming large volume of anhydride, and therefore the demand is much more than the volume which is available. So we have not seen any whatever you are saying. In fact, for us, it's an improvement in demand, and therefore our market share in European market is also growing.
Okay. Thank you, sir.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss Financial Services. Please go ahead.
Yeah, hi sir, good evening and thanks for the opportunity. Sir, couple of questions and a bit of clarification. First on specialty chemical. So even on quarter basis, we have seen the dip in absolute EBIT or EBITDA. Is it only because of the higher fuel cost and coal cost which you have just explained, or there was also some pressure on margins overall basis also, or some cost increase which we have not been able to pass on or pass on with a lag?
Yeah, Rohan, thank you. I think you are right that quarter-on-quarter specialty chemical reduction is not only because of coal. There are two incidences which happened which I would like to highlight. One, China was locked down for almost 2.5 months to 3 months in last quarter. And we have a good export of our specialty chemical to even China. So we have seen some impact of volume in China, and that also was very one-time impact. And the second one is also something which we do once in 6 to 7 years in our pyridine plant. We do catalyst change once in 6-7 years. So we did not plan that in this year, but we had to take that catalyst change during the first quarter. So we had impact of some volume in pyridine also, and these two reasons have led the specialty chemical quarter-on-quarter to be lower in volume. Otherwise, you are right that this was not only purely on coal.
So both of these reasons are one-off, and China has improved, and this shutdown has.
Absolutely. So some of the pyridine volumes we have not lost. It was only quarter to shift. So we are coming back with the better volume in pyridine, as well as China is now picking up in its facilities. So this was mostly one-off. You are right, we would have not seen that gap from quarter to quarter.
And on the coal cost increase which you have mentioned has impacted your profitability up to the extent of you mentioned 40-45 crore. Did I get that number right?
Yes, you're right.
So the coal cost still remains, I mean the government is still not giving us. So the coal cost scenario still will remain till 1st of September?
Yes.
Or it can go beyond that also?
Yes, we will be higher on cost, but yes, because volumes are improving, we are also trying to improve our pricing to the customer to the extent possible. So definitely the situation of profitability should be better.
Okay. So second question on our nutrition business. So there also we have seen that some kind of dip even on a quarterly basis and some margin compression. Any particular reason that has been driving this business a lower profitability in the current quarter?
So the nutrition business also has the impact of this coal cost. On pricing front, the nutrition business is stood well in the market. So it's only volume and the cost because of the coal. That's all.
Okay, so in nutrition there is no one-off like specialty. Except coal.
Nutrition
Except
is
coal.
one-off mainly because of the flu, which we highlighted very boldly that in Europe and US, no one is in a position to sell vitamins, and therefore volumes are lost because of this flu, which now is improving, and later part of this quarter is improving, and we will see the real normalized situation in Q3 of nutrition business.
Okay. So third question, if I'm allowed, and I can come back in queue again. In terms of this Europe energy crisis, what we are hearing is impacting many plants in Europe, and we may see some of the large plants like even BASF and all has given warnings that they may see the closure. Do you see that for our business? I think that we are definitely supplier to some of these chemical players in Europe as well. Do you see that there can be any kind of risk for our products that if those plants goes for closure, our volumes will be impacted in near term?
So if you see our product is we sell in Europe, they are mostly value-added products. What you are talking about mostly on building blocks, which are most energy intensive. Our end users of products are not very high energy intensive, and the contribution of energy cost to the finished product is not very large, which is affecting the overall consumption. So we have not seen any drop in consumption for our product in Europe.
Okay, sir. That's it from my side. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address the questions from all the participants connected in the queue, we request you to please limit your questions to 2 per participant. Should you have any further questions, you may please join the queue back. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, thank you for taking my question, sir. So one question is on this server specialty business. Just wanted to know what kind of progress we have made in that segment, and how has been the customer acceptance as of now?
I did not hear you. You are asking for dye PP?
Server specialty, sir.
Yes, can you be a little louder?
Flooring derivative.
Sorry to interrupt. Rohit, your voice is coming muffled, so if you're using any external headset, we request you to please speak through the handset directly.
Sir, I'm talking about the flooring specialty business.
Okay. So you are asking for fluorine derivatives in specialty?
Yeah.
Yeah. So that we have explained that plant is expected to start sometime next year. If you see our detailed presentation, we have said that it will start next year because the product is still under scale up, and we will decide sometime during this year at the end of the year, and plant should be ready next year only.
So on that, I mean, how the customer acceptance would be in progress? I mean, after completing the project, then only the samples would be sent to the customer, or already those are sent to the customers, and as and when it would be approved, we will be starting the commercial production?
No, so we already have a plant, as I explained earlier also. We have a fluorination plant from where we are developing 2-3 products. So all customer approvals are already happening from the existing plant. What we have announced is the extension of fluorinated derivative volume capacity that should come next year. So approval process is not hindered because of not having that facility. We already have a facility for the last 2-3 years developing the product, which is CDMO product, so which will take some time to scale up and bring it to the commercial.
Okay. And secondly, I mean, if at all possible, I mean, what kind of margin profile we should expect in each segment going forward on an annualized basis? As maybe in 1 or 2 quarters we may see some volatility, but on an annualized basis, would it be possible to give any ballpark number for a segmental margin profile?
So we have been saying that in our specialty chemical and nutrition business, our margin profile currently should be in the range of 18 to 20%. In our chemical intermediate business, our margin profile should be close to 10%. That's what we have been saying. And this improvement on this margin profile will happen as and when we are bringing the new capacities on specialty and nutrition to expand the ratio of specialty and nutrition revenue more, our margins will improve. So as of now, you can expect anything between 18 to 20% on annualized basis.
Okay. So basically your capex and all, which is basically coming up, and possibly as you are indicating that maybe Q2 also will have some costing pressure. So from second half of FY23, probably will be having a better margin profile.
You are very right.
Yeah, that's it from my side. Thank you.
Thank you. The next question is from the line of Bajrang Bafna from Sunidhi Securities. Please go ahead.
Thanks for the opportunity. Sir, last call also I was trying to understand, the acceptance of green chemicals. So when I say green chemicals, means the chemistry which is without the crude-based starting derivative. So you are the, one of the pioneer in that business and having a lot of experience of last so many years. and now, this decarbonization is a global story, which is coming up or shaping up very well. So, out of your existing product profile, how that ratio is, and the new capex that you are going through, which is close to 2,000 crores, what is the breakup, which is moving towards, this known crude-based chemistry or the green chemistry?
Yeah, I remember you mentioned this point, and we are already going through the process of evaluating our carbon footprint saving because of our greener product. So it will take some time. We are working on that. In addition to that, we are also working how to bring savings on our carbon dioxide emission with various ESG initiatives which we have taken, which I already announced in my speech also. So those details will be available after some time, maybe 6 to 8 months time. So probably you have to hold on, but we are definitely working on that on each of our products plus the new capex which we just said. I remember you mentioned this.
Yeah, sir. Yeah, I got that point, but even if not on the ballpark percentage numbers, I am just trying to understand from a customer's perspective that since, the Europe and the developed world wants to use more and more, non-crude based products or, the decarbonized products. So how they are demanding these products from you? Because, we have always seen that the price differential between these products and the crude based derivatives is always, detrimental for non-crude based products. But since now there is a theory, there is an acceptance, so whether those customers are demanding more and more green products from you, and that is why you have come up with this 25,000 metric ton acetic acid plant, which will purely come from non-crude based route. So if you could tell us something about that, it will be really helpful, sir.
So acetic acid case is totally different. Acetic acid is a green acetic acid, and there the demand is specifically, separately for food products. But the products which we are making in the specialty chemical, other products, they are used for pharmaceutical and agrochemical as value-added intermediates. Now, in the process, they are gaining some carbon footprint, but to the extent whether they will pay us higher price for that, today is a big question mark. But you are very right. Going forward, since the pressure on net zero is increasing, and Europe is taking the lead to source the product from the companies who are working on net zero, I think there we will get some benefit in our market share. But other than food grade acetic acid which is used for food, I don't think any product which we are supplying in agrochemical and pharmaceutical will fetch us some better price we have not seen in the market.
Okay, got it. So still it is, story of the future, not in the current scenario it is happening.
And remember, if we are supplying to any food business, absolutely spot on, you will get the benefit. But if it is a non-food business used as an intermediate, today people are not really looking at that case.
Got it. And sir, on the ethanol side, what is the additional capacity that we are putting up, which can help us to achieve this green route more frequently in the future?
So on ethanol side, we have already said that we are planning for one grain-based ethanol, which again we have still not committed capex, but it is in our planning. We are expected to do sometime in Q3 or Q4. We will announce that and we will start the process. You can see
thank you. Yeah.
You can see the planning of the new capex.
Thank you. The next question is from the line of Vineet Kala from Monarch Network Capital. Please go ahead.
Thanks for taking my question. So if you could, one bookkeeping question, if you could elaborate more on the inventory gain element that we have, due to which, the gross margins look very rich. Even with lower acetic acid prices, how did we accrue this gain?
Again, I could not hear you properly. Sorry. Can you please repeat?
Sir, can you hear me now?
Yeah, it is little better, please.
Sir, if you could elaborate on the inventory gain that we have, because of which, the gross margins look really rich. And even with the lower acetic acid prices, how did we accrue this inventory gain element?
No, so you are reading it wrongly. There is no inventory gain in the quarter. You are right. Actually, there is a loss of inventory of acetic acid because If you remember, we closed the last quarter at around $740 of acetic acid, and June quarter we closed at around 540. So there has been some impact negatively. What you see our margin in anhydride business is purely on volume. So we have grown significant volume in Europe, I mentioned in my earlier discussion. So volume of acetic anhydride is strong, and it is continue to be strong. And we are maintaining our prices also. So there has been impact of coal prices also on anhydride, but we are in a position to recover that. So we are fortunately in case of chemical intermediate, we are in a position to push the margins because of volume.
Sir, if I look at your this consolidated numbers, I see gross margins north of say like 49%. So is this sustainable? Is 40?
Beneath 49% gross margin, you are saying at the overall level, yeah?
Correct. Gross margin. So if I'm just looking at the changes in inventory, there is a negative amount of around 112 crores. So I just wanted to understand that.
That is because of extra volume we have sold.
So this is
so the low cost inventory got sold. This is what we mean to say.
Absolutely. Yeah.
Okay.
Vineet, I think the correct way to read it is because you are reading it with Q4. Q4, obviously, we had a very, very high inventory loss. That to that extent, because this quarter it is lower, so that advantage is also reflecting in this quarter's results. So because last quarter, that is why the profit of chemical intermediate was low, because we had an inventory loss, which this quarter is much lower.
We had an inventory loss larger than this quarter. Therefore, you see the better improvement.
Perfect, sir. Got it. Appreciate your response on this. So, sir, beyond this current quarter, I just wanted to understand on your plans on agroactives. So I came across a marketing template on your website only, wherein some of very interesting products which are being marketed, including fluroxypyr or pyriproxyfen. So what is the timeline around this particular project in terms of validation? What is the kind of pipeline we are building on the competition? So if you could throw up, some perspective on this segment will be very helpful.
So now that you have seen the product list in our website and you have realized that most of these products are quite exciting, particularly from the requirement of domestic market also, all those products are under approval process with customer, and also we have started working on regulatory approvals in various countries, working with customers. So, and the plant situation, as we have explained in our presentation, sometime in Q4 FY24, we will be ready with because it's a totally greenfield plant, so it will be ready by Q4 FY24, and so till that time we expect that we should be in a position to get the approval from customer, as well as we should be in a position to take our regulatory clearances from the various countries, and sales should be in a position to start from FY25 on.
So FY25 onwards. And sir, how big can this segment be over, say, like 3 years after it starts, over FY28, 27? So how big can this be, given the kind of pipeline we are targeting?
Because we are making phase-wise investment. In the first phase, we are almost making an investment of 200 crore or so. And as we have said that in agrochemical, our asset to turnover will be close to 1.5 to 2. So that's phase 1. And then phase 2, which will be herbicide and further expansion of insecticide, that we have not yet announced. So you can keep calculating the growth prospects for that business.
Fair enough. So that's it from my side. All the best. Thank you.
Thank you. The next question is from the line of Nitesh Dhoot from Prabhudas Lilladher. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. Actually, just wanted some clarification on slide 45, which is on capex.
Yeah.
So if I see this slide and I compare this with the Q4 presentation, one capex item has been removed, which is acetaldehyde. But you see the total amount committed that has increased from 800 crores to 900 crores.
Yeah, that acetaldehyde investment was more for captive, which has gone along with the other investments. So that is why you don't see that. Normally, acetaldehyde is our captive consumption, which also is used for our food grade acetic acid. So that is already completed and part is being completed. So you will not see that as a separate investment. No.
But then why is the amount gone up from 800 crores to 900 crores?
Sorry, I didn't get you.
The total amount committed, that has gone up from 800 crores to 900 crores, whereby there is no additional item that has come in. So why is this?
Yeah, amount is going up because of the overall market situation of capex cost, etc.
So, Nitesh, if you see the total investment remains the same. So we had, when we had come to you in May, we had disclosed the commitment till that time. And since then, over this quarter, we have made a further commitment of 100 crores. So 800 has become 900. But you would see on the future, there is a corresponding, earlier it was 1250. Since 100 has come here, so it has become 1150. So the total remains the same. Since we have committed 100 crores now, so that 100 crores has shifted from the bucket of to be committed to already committed. So out of this 100 crores, 75 was in specialty and 25 was in chemical intermediate. You would also, when you will compare it with the last presentation, you would find that there is a corresponding decrease in these numbers. Earlier, we had said specialty as 750, which is now 675 because 75 has already been committed. And earlier, the chemical intermediate was 300. Now it is 275 because 25 is already committed.
And remember, these capexes which we are writing on this slide are the major capexes. But beyond that, as we explained in various calls, that we keep doing debottlenecking of our existing facilities, and therefore you see some numbers changing in our commitment. So that's a continuous process. So you will see some changes in number, but you will not find that in specific capex here, because these are only major capexes which we are having.
Sure. Okay. So, sir, so another one on capex itself is, if you see the page 46, can you just help understand, this slide a bit better? How should one look at it? Is it in value terms or in tonnage terms? And if I just, ask you about the specialty chemicals, so that has more debottlenecking versus new capex.
Nitesh, I'm sorry, but you're not clearly audible. Can you just keep a mic at a little distance so that we could hear you clearly?
Yeah, sure. Let me. Am I better? Am I any better now?
Yeah, better.
A little better.
Sure. So, okay. So, sir, just to follow up on capex itself, I was talking about slide 46. If you could just help us understand this a bit better, as to how should one read this, these numbers, is it in value terms or in tonnage terms? And if I'm looking at the specialty chemicals particularly, you see there is 3.5% mentioned as new capacity, whereas 13.6% is debottlenecking. Despite three upcoming plants, major plants, GMP, non-GMP, and another one, I believe, all put together would be 3.5%, versus that debottlenecking would be such a large number. If you could just give some color on this.
Yeah, so what you are reading here is not the capacity. This is actually our revenue profile. So the capexes which will be rated this year, all of them are coming in Q3. So you can imagine that in the current year, the impact of the revenue from those capex will not be that significant. That will come in future years. That's why you are seeing that.
Okay. So maybe just one more question on on capex. So 2,000 crores of capex, put together, adding around 4,500 crores of top line. implying a 2.25 asset turn. Would it be possible to break it up, segment-wise?
Yeah, we can broadly give you the segment-wise, but you don't take us for granted on that. But roughly, on a specialty segment, it could be close to 1.5 to 2. In nutrition segment, it will be close to 2 to 2.5. In chemical intermediate segment, it will be 2 to 2.5.
All right. Okay.
Because it's mostly the batch processes, so you find the investment more, but the revenue is not there.
Sure. So, I'm sorry, if I can just add one more question. So, one question on the nutrition business. So how much would the specialty premixes contribute to nutrition business currently?
That's not very significant. That's a small business which we are growing now.
Right. Right. So,
as such, nutrition premix business in India is not very large, and currently we are focusing Indian market because the market is now growing significantly high. Because now animal feed segment is looking for more and more premixes. The demand is growing, the market is growing, and therefore we are also launching new products. Though the value will be not large, but they are very niche segments where the margins are better.
Right. So, would it be fair to say that niacinamide would be, large part of the business, maybe like upwards of 75-80% for your nutrition segment?
Yes, you are right.
Yeah. And just looking out this quarter's disappointment because of the flu, would it be fair to say that niacinamide would be at near full utilization for you?
Yes, you are right. It was lower utilization of capacity.
So how do we see growth coming in the nutrition segment? For large part of FY23 or maybe FY24, given that, what I see is that, there's some delay in the case, that we were supposed to come up with. That was function on.
We have said that in the current year, we are not expecting the volume growth over last year in vitamin B3 because our first quarter and second quarter will be impacted. But from Q3 onwards, the demand will be normalized and we will see the Q3 and Q4 in the normal situation.
So Q3 and Q4, so H2 versus last year's H2 would see volume growth?
Yeah, so last year we will see some impact in volume. We could see some impact.
Okay, but then since we were at peak capacity utilization, what was the rationale behind delaying the 20% increase in niacinamide capex?
Can you repeat the question, please?
So what I understand is that the niacinamide capex, the 20% increase that you had mentioned earlier, that increase is not happening this year, right? So
no. So listen, we are adding that capacity because in half to H2 this year also the volume will be definitely more than last year H2. So growth is happening just because of this one-time impact in Q1 and partly in Q2. We will need capacity in future because vitamin B3 is a very important product which we have never seen this situation what we have saw in Q1 and Q2. So we will go through the capacity expansion. We are going through the capacity because we will need capacity in H2 this year also.
So that will happen in this year only, or it will happen in FY24, the expansion?
This year, and mainly we will do in next year.
Okay, all right. Okay, so thank you so much and all the best.
Thank you. The next question is from the line of Sunil Kothari from Unique PMS. Please go ahead.
Thanks for opportunity, sir. Are you getting my voice?
Yes.
Thank you, sir. Sir, my question is a little long. Please bear with me. My point I would like to understand is, during last 3, 4, 5 year, India as a chemical industry, you as a Jubilant Ingrevia, we got benefits of lot of things like China's pollution problem. People were finding out some China plus one in between COVID and some supply disruption, and so advantage of very high prices. So many things happened. So with your experience and your vantage point of last 30, 40 years experience, how you see this, any major change happening in terms of, say, Indian chemical industry's capability or prices or demand? Would you like to say some few sentences on this situation? Is there any change measure that China again coming back in supplying and competitiveness is increasing? Anything on this thing?
So we are seeing two changes clearly in the industry, at least for us. One is our end-use customers. Some of the products which were produced outside, now they are more produced in India. And therefore, if you see, our domestic sale is also strong. And if this happens, you can fairly assume that our consistency becomes much better, because then the competition from China is normally neutralized, because the domestic customers would prefer to buy from us as long as they get a good quality and good price. That is the one change. The second, as you said, the customers are now looking at an alternate option to source. So definitely, if they have an option of China and India for the same product, they would prefer us to see they sell more share, and therefore our share of each of our products to our existing customer and new customer is increasing. These are the two clear changes we are observing.
So, sir,
and
both.
The third one is the new inquiries for our CDMO business is also upward. So that's also there.
Right. So, sir, both this change indicates that people like us have a bigger opportunity compared to last 3-5 years. Next 3-5 years should be a domestic import substitution and plus higher exports.
Yes, and that's good. That is one of the reasons you see in our growth capexes. We have both. We have new product capexes as well as we have capacity expansion capex. So, like CDMO, CGMP, anhydride, vitamin B3, all these are, the mix of capexes. They are not only for the new product. They are new product as well as capacity expansion.
Right. And sir, just this first quarter's numbers, mainly because of this power and fuel, almost 100 crore plus compared to last year. It shows, sir, there is some high competition in the market compared to some previous last 12 months or 24 months, or how to look at this situation?
So if you see the competition of the similar product segment, I think everybody is impacted in the same way. Of course, if you see the competition in a different product segment, different business segment, obviously that will not be a good comparison.
So will it be possible to pass on this cost if it continues, or we have to absorb and improve our cost efficiency and productivity?
No, if it continues, obviously we have to pass on this cost because we can't keep absorbing these costs. So as we explained, partially we have passed on, some more we will pass on in this quarter, but we hope that it should normalize. If not, obviously we will have to pass on.
Correct. Great, sir. Wish you good luck. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Romil Jain from Electrum PMS. Please go ahead.
Yes, sir. Thanks for the opportunity. Can you hear me?
Sorry, sir, we are not able to hear you clearly.
So, yeah, you can hear me clearly?
No, your voice is breaking up in between.
Yeah. Sir, one of my question is on the capacities that we are setting up. The 2,000 odd crores of capex that we are doing. Segment-wise, do we see, in any of the product segments, any oversupply kind of a scenario in the industry?
No, we don't see in any of our products oversupply.
Okay. So that means, in those segments, we should retain some pricing power as and when we need it.
Yes.
Okay. And similarly on the decaying, yeah, sure.
As I explained even in the last question, most of our product demand is growing up, right? So we are expanding capacity. So we are not seeing any pressure on our existing products of overcapacity.
Okay. And sir, on the nicotine side, just want to understand in terms of ramp up, once we are through with this ramp up of the first phase, when do we start the next phase? Do we have some visibility on the demand scenario, and how fast we can, ramp up the second phase also? Because, why I'm asking.
Romil Jain, we lost your audio. As there is no response, we'll move to the next question from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Hello, am I audible?
Yes, please.
Yes. Just wanted to check between the three businesses, which of them is the most intensive in power and fuel, and which one is the least?
Yeah. So specialty chemical segment is the most power intensive, and then second is chemical intermediate, and then the third is nutrition.
Okay. Thank you.
Thank you. Ladies and gentlemen, this was the last question. I now hand the conference over to management for closing comments.
We thank you for joining this call today. We hope we have been able to answer your queries. For further clarification, we would request you to contact our investor relation team. Good evening, and thank you once again for your interest in Jubilant Ingrevia.
Thank you. On behalf of Jubilant Ingrevia Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Yeah.